Hello everyone and welcome to your Glassnode video update for week 40 2022. So despite the fact that the markets continue to languish down here in the 18,000 to 19,000 realm, Bitcoin hash rate has pushed to yet another all-time high. This is one of these remarkable elements of Bitcoin that the free market operates in the background, hash power redistributes, miners have to sell their coins, someone else buys the equipment, but the overall network is effectively self-correcting, both by the difficulty adjustment and the human incentives of mining. So truly quite a remarkable thing to see the resilience in this industry. So what we're going to do today is really do a bit of a deep dive into the Bitcoin mining industry. And there's lots of really interesting metrics that we'll cover. I'm describing everything from the observed behaviors. We've got a couple of new pricing models that are trying to actually assess the cost of production. So think about this like the cost basis, the estimated cost basis of miners in the system. And we're also going to look at the associated stress that happened. We looked at a couple of weeks back, the overall capitulation potential. Are we seeing miners under actual distress? And what we're going to look at today is actually an even finer subset of that, specifically looking at Poolin. Because what we saw is that they actually issued an announcement saying they were having liquidity issues, and very quickly we saw miners start pointing their hash rate. They went from something like 12% hash rate dominance down to like 3.6% in a matter of weeks. And I think it was even less than 1 week. So it really shows just how quickly miners can point their hash rate to a different pool when something goes wrong. So a really interesting case study and how we can use Glassnode tools to identify that. So as always, please do give us a rate, a share, and a subscribe. And I will show you some of the really cool new dashboards and workbenches that we rolled out recently. I'm trying to give you a lot more coverage of what's going on in the mining industry and the stablecoin industry to really just understand what's going on. So we're rolling out lots of new dashboards over coming weeks and months. So do stay tuned for those. Okay, so starting here, we're looking at our week 40 dashboard, which as usual, you will find in the description below. You can see that we are essentially still in this consolidation range and have been here for some time. Now, I've been in this market for some time, and there's been two periods that really stood out to me when we've had very quiet price action like this. This doesn't happen very often with Bitcoin. It's a very uncommon phenomena. The media loves to talk about how it's the most volatile and dangerous thing on the planet. So very rarely do we go into these very quiet periods. So there's been two times in my experience. I bought the very top back in 2017-18. So I've been here since then. And the two periods that this feels like, the first one is November 2018, right before we took a 50% haircut and sold down from 6,000 to 3,000. So that's point one. Point two is back in April 2019, which was where we went the exact opposite direction. Everyone was calling for $1,000 Bitcoin, and instead we went to 14,000. So it really does feel like we're in this period where in either direction, volatility tends to follow these periods of very quiet. So something to pay attention to. And the reason why we're going to look at the mining side is that we have some of these production cost levels quite close below us. And that's kind of a period of acute pain, which could trigger that sell side. So just kind of assessing the mining industry as one of many components inside that risk profile. But anyway, that's just a little anecdote from my experience personally. So what we've seen here is the hash rate has pushed to yet another all-time high. You can see that we're about 30% higher than we were back here when the great mining migration. So we've seen more hash power come online, and it continues to recover even as price trades sideways. So this is a very interesting dynamic. Hash rate is driven by many things. Both ASIC machine efficiency. There's probably new rigs coming to market, so they actually have more hash power per unit of power input. So we're starting to see those come to market. Profitability can change. Some miners can, they can redistribute their hash power. The stronger miners over the course of a bear market will tend to expand their operations, and weaker ones tend to drop off. So it's a bit of a reshuffling of who has the hash power and why. And it's essentially a move towards stronger balance sheets. So in many instances, hash rate follows price over the long term. Over the short term, you can get these very interesting disconnects, but that doesn't necessarily mean that price has to follow. So generally speaking, hash rate will follow price. within the context that there are some of these endogenous reasons, such as, new ASIC efficiency and things like that. So more of an interesting observation. And just for the analysts in the room, I always look at hash rate on a 7 or usually actually a 14-day moving average, because there's so much natural variability. Taking daily readings is just not really the correct way to do it. So something like a 7 or a 14 will just give you the more correct graphic. So if you see people sharing charts that are just daily resolution, you can generally poke them and say that's probably not the right way to do it. So what we're looking at here is the hash ribbons, and I might just whack this on a 5-year. And I will actually, just while we're here, drop this onto a linear scale. So by the way, if you are using dashboards, you'll find that setting up here in the top right. Edit, you can change it between linear scale. You can change what moving average you want to apply, so on and so forth. So let's zoom in on roughly the last 3 years. This is the hash ribbon, and it's looking at the 30-day moving average in green, so a faster, and a slightly slower moving average, the 60-day. So what this is basically looking for is changes in momentum. And we're looking at fairly short-term momentum. We're comparing 1 to 2 months. So we're really looking for periods where the green line dives down below the blue line. You can see here back in May 2021, this was a significant period. About 50% of the hash rate came offline. And when it breaks back above, what it's saying is that hash rate is recovering. The mining industry is under less stress. When the mining industry is under less stress, they can sell less of the coin. Now, that could be because prices rise. It could be because, in this instance, the miners actually literally relocated. Whatever the stress is that's imposing additional costs on them is alleviated. So historically, this tends to support somewhat positive price action coming forward. It's not a guarantee. We can see back here in 2019, as we came in, the follow-on was March 2020. So it's not always a signal. However, when this does occur, it shows that at the very least, the mining industry has less stress in it. And that's one less stress in the entire system, which generally, the more, the less stress you have in the system, the more people who are in the green, so to speak, the less likely you're going to have extreme selling pressure. So it's one of those things that we're looking for confluence across many things, and miners. That's why we're deep diving here to just assess what's going on in the mining space. So we did see an unwind here starting at about mid-August, and we are now, as I mentioned before, at all-time highs. So overall, this is signifying that the mining industry, on average, is actually in a reasonably healthy position. At the very least, they're much healthier than they were back in June when we had that sell-off. So it gives you a bit of context. There's been some restructuring in the industry, and we are in a far better position than we were, even though price is pretty much at the same level. That restructuring of ownership and balance sheets is in a superior position. So here is a really interesting metric. We have this actually as a Workbench preset, which we'll explore in a minute, called the mining pulse. Now, the target block time for Bitcoin is 10 minutes or 600 seconds. Now, higher values that you can see during this capitulation here in 2018, you can see it at March 2020 and the halving event when their revenue literally cut in half. And then here's the Great Migration. These high values mean that blocks are slower than that 600-second block time. It's basically showing that hash power is coming offline. So we are seeing that relative to the target, we are seeing a massive slowdown in blocks. Now, conversely, when we have lower values, it means that blocks are faster than 600 on average. So that's a speeding up. You've got more hash power coming online, and the difficulty has to, over time, wind up to accommodate that. So you can see that because of the difficulty adjustment, we continue to revert back to the mean line, which is 600. This is Bitcoin's natural equilibrium. It's always trying to bring hash power back online. Now, what I want to note is we have seen, if we just look at the recent period, we've seen 1, 2, 3 spikes above, so slightly slower blocks during the capitulation that's here. But note how it looks nothing like these things. These were kind of single flash events, big shutdowns of mining hardware. We saw people, miners had to just turn off at a very, very short notice. There was an event, March 2020, the halving event, the Great Migration, the capitulation back in 2018. These were events. And following that, we kind of had the big stress. It was a big flush out and the system reset. Here, we've had a bit more of a sustained, multi-month prolonged kind of pain, but we haven't had as much of an event. Now, since then, we have sped back up. It started to revert back to the mean. So as I mentioned, the mining industry seems to be reasonably stable, and it does remain to be seen whether we still need to have the event, right? That big flush out that just scares everybody. We'll talk about that in a second. Or if this multi-month kind of prolonged period has been kind of equivalent, right? So imagine many, many months of pain being equivalent to 1 month of extreme pain. It's kind of, have we spread that risk out over time, or do we still actually have something that's waiting in the wings to really capitulate and kind of scare everybody and bring that sense back in? Now, naturally, when hash rate is at all-time high, the protocol difficulty is going to keep winding higher. As more mining hardware comes online, this is the beauty of Bitcoin. What difficulty does is it will continue to adjust upwards, make the puzzle harder, make it harder for the miners to actually solve, to keep that 10-minute block time, and that keeps the supply dynamics, the actual issuance of coins, on a predetermined schedule. So the difficulty adjustment remains one of my favorite components of the Bitcoin protocol. It really is just a marvel of simplicity in the way that it works. But, as before, we are somewhere around 30% higher than we were back here prior to the Great Migration. So this shows both more hardware coming online, but also a net recovery of the industry. Now, the implication of rising difficulty, and the reason why difficulty is such a powerful tool, and we're going to talk through a number of metrics that use it as an input to actually estimate the cost of production, it's essentially the price of mining. You can have miners all over the world with different power costs. Some guys got it for 3 cents, some guys got it for 12, some guys mining S9s, someone else is mining the latest and greatest hardware. It actually all compresses down into one number: protocol difficulty. And we estimate hash rate from difficulty. So hash rate's actually an estimated number, whereas difficulty we can measure from the blockchain itself. So it is a known quantity, and that's what makes it the perfect tool to actually measure the cost of production for BTC, which we'll touch on in just a second. Now, this chart is a really fascinating one. This is looking at the miner revenue per exahash. So what that means is at the moment, there's something like 240 exahash on the network. Actually, let me go back and check that, because we're literally at all-time high, so there's no excuse for getting that one wrong. 242 exahash currently on the network. So if we look at that, let's say one miner has one of that 242 exahash. How much revenue are they going to earn per day? You could use this tool to estimate, if you're looking at mining equities, you could use that to essentially assess competitiveness. You can also look at it if they're starting to expand, or you're trying to assess what kind of hash rate. Let's say it went up to 300 exahash, you could start to project forward. So in the blue, we're looking at USD, and in the orange, BTC. And you can see that obviously one is affected by price, one is affected by the halvings and fees and all the rest of it. So let's zoom in on the last 5 years and really get a good view of this. So what's quite interesting, note how the orange, which is the BTC denominator reward, it just keeps going down and down and down. This is a function of two things. One, obviously the supply goes down with halvings, but simultaneously, you've then got more hash rate fighting over a smaller number of coins. So the increase in competition is essentially driving the price, or the reward per hash, down towards zero. This is why mining is such a competitive industry. You continue to have more hash power, both by efficient machines and more of them, fighting over an increasingly small number of coins. So on a BTC denominator basis, the competition is actually the most fierce it's ever been. You will get 4.06 BTC per exahash you apply. So there's obviously 242 of those. So if you multiply that out, you get somewhere around the 900 BTC per day. Now, on a USD basis, this is where it's actually really interesting. So note how we've essentially come back to October 2020 levels, October, September. So we're roughly at the same level. You're earning the same amount per exahash, but price was $10,000 back here. Here we are, price is 20,000, give or take. So we're talking about a doubling in price, and yet miners are earning the same amount. So what that's actually showing is that this discrepancy here, this is because there's more hash power fighting over that same block reward. Essentially, since the bull run started, even though we're twice as high in price, there's essentially 2 times as much competition, which means that the revenue per exahash, something around $80,000 per day, per exahash per day, is essentially back to September 2020 levels. So you can see that this is a really, really competitive environment, and it's essentially, it's pure capitalism. Bitcoin mining is the most capitalist industry that I've ever seen. It's essentially fight or die. You really have to be best in class and have the best balance sheet, and it's pretty ruthless. And you can really see this by the lifetime chart. your revenue is going to go down unless you continue to compete and innovate. It's a brutal industry, but those that succeed in it, essentially mining the hardest money and trying to do so at the most efficient price. So quite a remarkable little system. So now I want to touch on two models that are trying to assess what is the cost of production for BTC. What is essentially the all-in mined cost of BTC? Now, obviously, we can go and ask every miner and try and probe and find out, or we can do some clever mathematics and some statistics using some sensible inputs. So, as I mentioned before, difficulty is one of these really, really powerful tools. It's the all-in price to mine. Now, this first model is the difficulty regression model. So what we've done here is what's called a log-log regression. It's essentially looking for what is the correlation or the causation between two different metrics. In this instance, we're looking at market cap and difficulty. Now, this returns a very, very high R-squared coefficient, which is basically how linked these two parameters are. And it's about 0.944, which, by the way, is one of the largest that I have found in the industry. You can do regressions with all sorts of things. There's been a few popular models in the past that have tried to do this. What the difficulty does, it's essentially the most tethered to price that I've seen. And this makes sense because as price goes higher, as market cap grows, as the industry grows, the Bitcoin mining, we went from laptops to now consuming a small nation worth of power. So there's many, many millions of machines. And actually at the very top, if you want a quick piece of fun fact, for all, in terms of the hash rate that we've got going on, for all 7.75 billion people on Earth, this is essentially equivalent to them doing a SHA-256 hash 30 billion times every second without fail. It's a huge number. And in order to compute that or perform that, it really is, it shows you the level of computation that's going on with the system, and it grows with the Bitcoin market cap. So bringing it back to this particular model, we are currently hovering around $18,200. So what that's saying is if we take an average price, some miners are going to be better off than that. Some miners may be, earning it at $12,000 per cost. Some may be mining it at $20,000, are currently sitting at a small loss. So when you actually average all this out and best estimate, the cost to mine, or kind of the middle of the road, is somewhere around 18,000. Now, it actually caught the dip back here in June. It was 17,600 back then. We've had a bit more difficulty coming online, but you can see that we are hovering just above it. So the key takeaway here, if we were to trade down below 18,000, some of that health that we've seen re-enter the mining market may turn back into acute stress. So it gives us a bit of a measure, all right, a bit of a gauge for somewhere around that 18,000 level. It's possible that we start to enter a regime of minor stress once again. So it kind of gives us a threshold to be paying attention to and just watching. But like many commodities in the world, Bitcoin has returned to its cost of production line. Now, this was another model that was actually proposed this week. So this is brand new. It is now live on Workbench. What this model was looking for is essentially the difficulty per issuance. So trying to establish how much difficulty needs to be expended on a raw hashing basis in order to earn the block reward. Very, very simple concept, and then doing some mathematical fitting to try and achieve a, what makes sense. And what we've done here, the pink line really is that's the actual model itself. Then we've got a multiplier up the top. So this purple line is what it would look like after the next halving. So a doubling, halving the issuance, meaning a doubling of the cost of production. And then this orange curve here is the geometric mean between those two. So giving us a bit of a middle of the road type gauge. So the pink line is the actual model, and it has been deliberately fit to sit near the bottom of bear markets. Why is that? Because at the bottom of a bear, as we saw with the mining pulse, that is where only the most efficient exist. So we're trying to model what is the most efficient cost of production for the best miners in the industry. Where is the point where the best miners in the industry are able to currently compete? So it's currently sitting down here at 12,200. So as I mentioned, it is below that middle of the road 18,000 from the model above, which is kind of the average miner. The best miners in the world, we estimate, are somewhere around 12,200 in their cost basis. You can see that the middle of the road, that geometric mean is about 17,000. So again, we're starting to see that 17 to 18 zone being a point of interest. You can see why there'd be some support there in terms of the cost of production, but simultaneously, if we trade below it, a zone of some potential stress. And sitting above that, so if we were to have the halving tomorrow, the cost of production would go up to about 24,200. So you can see why these things generally over time, we get these ranges that we can start to actually scope out. Where are the weakest miners going to be? Up near the purple line. Where are the strongest miners? Down there near the pink line. And where is the average miner? Somewhere around that $17,000 to $18,000 realm. So now we at least have some pricing models that we can use to assess and gauge where the mining market may enter acute income stress. So as I mentioned at the start, I just want to give you a very, very quick overview of some of the really cool metrics we've recently rolled out. We're in a process of actually launching a great number of what we call Workbench constructions. So you'll find these inside Workbench on this left-hand pane. Underneath your My Charts, there is a suite of all manner of new Workbench charts. So most recently, we rolled out a series for the mining cohort for Bitcoin. So here's that difficulty regression model. Here's the difficulty per issuance. We have our miner revenue per exahash, the mining pulse, and we'll shortly look at the miner capitulation risk. Now, alongside that, we recently rolled out a whole suite of stablecoin metrics. Now we're looking at all sorts of things like supplies, dominance of various stablecoins, flows in and out of exchanges, and a really neat metric called buying power, which I'll jump across to our recent dashboard. So much the same, alongside those Workbench presets, we're also revamping our dashboard suite. So this is a work in progress. You'll see these coming out progressively over time. But some of the ones we recently rolled out was stablecoin supplies, stablecoin on-chain activity, and stablecoins with exchanges. Now, this is one that's really quite interesting. What we're looking at here is the flow of stablecoins in and out of exchanges. Now, stablecoins have become one of the most pivotal and important parts of this industry. They've become the quote asset on both decentralized and centralized exchanges. So what we're looking for is that matching of, is there more stablecoin power? What's the buying power of the stablecoins relative to BTC, ETH, or whatever other asset you happen to be looking at? So we can see here we've got our exchange flows both in and out, mapped out in terms of aggregates, Tether, USDC. So we're really looking at the top four here: USDC, USDT, BUSD, and Tether, and DAI. So the metric that I really want to highlight that I think is quite neat. Now, these are Workbench constructions. So again, you can jump in here on the top right and actually inspect how they've been built if you're curious to learn more. But this one is one I've called the exchange buying power metric. So what we're looking at is two things. We have stable coins flowing in or out. Consider that the buying power. The selling power are BTC and ETH combined. They're the two largest assets flowing in and out of exchanges. So these orange bars down the bottom here signify that over the last month, BTC and ETH is flowing into exchanges. So this will turn orange essentially when there's a lot of sell pressure flowing into the market. Note how it went orange as we sold off here in this May 2020 and actually went orange near the top. So you can see that we had large inflows that were going on near the top of these large sell-offs. So the orange is signifying there's coins flowing in. Now, what I've done with this net position change metric, it will turn green when, yes, we have a whole bunch of coin flowing in, but we have more stablecoin flowing in. So if you've got $1 billion worth of BTC and ETH flowing in, but 1.5 billion worth of stablecoin buying power, this will go green. Conversely, when there's more coin than stablecoin flowing in, it will turn red over the last 30 days. So it's trying to identify periods where you actually have a balance or more buying power or less buying power on the red side. So this hopefully is a useful tool to try and map out those macro funds and just essentially boil it down to Bitcoin, ETH, stablecoins, and just simplify into one thing. Anyway, let's get back into the action. So for the last section, I want to look at miner capitulation and essentially balance changes. What's the actual stress? Now, I use two different concepts here. The first one is what I'm going to call implied stress. We're essentially guessing, we're estimating. We're using tools that say, I think that miners are under stress, but we don't actually know. So the Puell Multiple is one of these old faithfuls. It's looking at the miner revenue over the recent period versus their yearly average. Are they making more or less than their yearly average? Now, we've seen a reasonably strong recovery off the bottom, signifying that over the last couple of weeks or last couple of months, the overall stress on their income is a little bit better. They've become more adjusted. They're kind of getting used to this $18,000 regime. We're starting to get to a little bit more of a stable baseline. We generally see very large pushes off the bottom near bear market lows, but remember, we can always revisit. So what we're looking at here is, do we get a continued sustained reversal? At the moment, this aligns with our hash ribbons. We're seeing a superior position for miners. Their income is less stressed than it was just 3 or 4 months ago. So it kind of supports what we're seeing in the hash ribbons. So this is an implied model. We believe, based on their income and based on where their thresholds are, that at the moment they're actually not in too bad of a position. What we then combine that with, so here's the Puell multiple again in orange, is an explicit stress. So that means, like the hash ribbon will only decline when hash rate is literally turning off. It shows that the actions of miners, the factual observation of what they're doing, is stressful, right? They are under income stress, they're no longer profitable, and thus they must turn machines off. So that's an explicit observation. What this model is doing is combining with these yellow zones in the background. When the Puell multiple, their implied income stress is low, so they're under income stress, we estimate. And the purple curve is the difficulty ribbon compression. It's kind of the difficulty ribbon version of the hash ribbons. Now, when this is also low, it signifies that not only is the income stressed, Puell multiple, but also we're seeing them switch off their hardware. So both of those things combined will flash a yellow signal. Now, as of yesterday, this reverted back to a non-stressed condition. However, there are periods of time during these bottoms where it flashes on and off again. So what we're really waiting for here, if we were to zoom in, what I'd be waiting for is this thing to actually go, essentially turn off and say that the capitulation risk has passed, and hold that level for a couple of weeks. That would kind of show that we've actually probably exited the regime of miner stress. Now, why do we care about miner stress at all? Well, the primary reason is that they have treasuries of BTC. So I've got two curves here. In the blue curve, we have miners that we have not labeled. So essentially, a lot of this includes the Potoshi miners and miners from way back in the day that, essentially they were so small and, they accumulated a lot of coins back then, but we don't know who they are. So we can see that their balance has actually been fairly stable, about 660,000 BTC. Naturally, you see how with this big expenditure during the bull run, there's still some of them out there, but we just don't have the labels for them. And by the way, these account for about, at most, 4% of the hash rate at the moment. So we actually label the vast majority of miners. These are just ones that we don't have. And the reason there's 660,000 coins, a huge portion of these were mined back in the Satoshi era. So we just have no idea who they were. And those coins haven't moved for many, many years. So I'm less concerned about those. What's more interesting is the orange curve, which is all of the miners who we have labeled. And they currently hold 78,000 BTC. Now, that doesn't mean that they're going to sell all 78,000. That's very, very unlikely. But it gives us a ceiling in terms of total risk. If we were to fall down below cost of production, potentially there's 78,000 BTC. Some portion of that could become additional sell side. So what I want to look at here, just to close this out, is the miner net position change. We're looking at, are they actually spending? So at first pass, this looks like they are spending at a rate of about 9,000 to 4,500 BTC per month, right? We can see that their balance is coming off the highs a little bit. So it looks like they are spending a bit of their treasury. However, that orange curve here is the all miners. The blue curve is one single pool called Poolin. Now, Poolin had about 12% of the hash rate as of about 1 month ago. So what we can see is that most of this spending activity is being driven by Poolin, a single mining pool, which is quite interesting. So what we've done here, if we look at all, that's 900 BTC they get earned per day in block reward on average. So if one particular miner is earning 90 of those 900, we can estimate, that's just 10%, we can estimate they probably have around 10% of the hash rate. Now, a couple of weeks back, Poolin had 12.5 to 11, 12% of the total hash rate. This is their purple curve here. They had a huge dominance in the hash rate market. except look how it's cratered down to 3.6%. What we're modeling here is that their revenue in terms of block reward declined from earning 12.5% of the total block reward to earning just 3.5%. And amazingly, this actually aligns with a date that they put out an announcement saying they were having liquidity issues, meaning we don't know what exactly they are, but they're under some kind of financial stress. They didn't have the coin to actually cover their liabilities. Now, this decline was almost immediate. All of these miners essentially switching a miner, changing a text file, an IP address where you're going to point your hash power, and hitting save. That's essentially what it takes to actually change where a miner's hash power is pointing. And we can see here just how quickly miners transitioned, moved their hash rate somewhere else. As soon as there was trouble in paradise, they pointed to somewhere else, which is quite remarkable, but it kind of shows how Bitcoin mining works. In real time, we can actually assess that miners transition their hash rate away from Poolin and towards other pools. So thanks as always for tuning in for that one. Hopefully you enjoyed that deep dive on mining. Do let me know if you enjoyed this kind of format, going a bit more into a singular topic and really exploring what's going on in the Bitcoin mining space. Do let me know. Please check out those new workbenches and dashboards. They really are a powerful suite of tools. We're rolling more out every single week. And there's a whole lot more in the pipeline. So a lot of really exciting stuff coming out. And I do look forward to seeing you in the next video. Cheers.